Thank you, Martin. I'm going to start by reminding you of the background to what we're going to be talking about today. In July 2017, Andrew Bailey, the chief executive of the FCA, said that the FCA would no longer intend to persuade or compel banks to submit contributions for Libor after the end of 2021. In the view of the authorities, the problem with Libor is, first of all, since the financial crisis, the structure of financial markets has changed. Libor has become the rate at which banks do not lend to each other. Second, Libor is a risk to financial stability. The pricing of hundreds of trillions of dollars of financial instruments rests on the expert judgment of relatively few individuals. And third, in the period before the introduction of benchmark regulation in different jurisdictions, there was more scope for Libor to be manipulated. So to avoid these problems, the authorities want financial markets to transition away from Libor and the other IBORs to near risk-free rates. In all the main jurisdictions, the chosen risk-free rates are overnight rates. SONIA in the UK, SOFR in the US, ESTA in the Euro area, SARON in Switzerland, and TONA in Japan. A common objective is to make risk-free rates as robust as possible, with robustness measured primarily by the volume of underlying observable transactions. And the transition to risk-free rates is a global challenge. It will only succeed if the authorities and market participants work closely together. And to help organize the transition, the authorities have set up a series of working groups with market participants. So, I am very pleased to welcome today senior officials working on the transition in 4 main jurisdictions involved. To my right, Harriet Hunnable, Manager of Benchmarks Policy at the FCA in the UK. To her right, Matthew Lieber, Director of Capital Markets and Institutions in the Markets Group at the Federal Reserve Bank of New York. To his right, Cornelia Holthausen, Deputy Director General of Market Operations in the European Central Bank. And to Cornelia's right, Roman Baumann, Head of Money Market at the Swiss National Bank. And we're going to discuss some of the key issues affecting market firms. First of all, the progress that has already been made with adoption of risk-free rates so far. Secondly, the challenges ahead, and there are many of them. And third, delivering the transition, what the authorities are doing and what the authorities want the market to do and the timetable for doing it. So this panel affects everybody in the room. And we're going to start with progress to date, and I'm going to start with Harriet.
Well, thank you, and thank you, Paul, very much for bringing us together. We speak a lot by telephone, and so it's great to have a sort of mini meeting here as well as to join the conference, so thank you very much. Well, progress to date. First of all, I'd just like to come back to that point, which is awareness. So the key thing, I think, in terms of progress across UK markets is that real awareness that there is a risk that Libor will not be sustainable after the end of that agreement. And that risk is real, and we have put out various public statements just to make sure that the market gets that key point, that this is a real risk. And I think that's largely been understood, but there is a challenge in terms of that being well understood all the way down the chain. So progress is, in terms of awareness, is quite good. And a very clear message that that is a real risk and that there is really no choice about change. Another key set of progress in the UK, we're very pleased with how things are going from choosing SONIA, an existing overnight rate, to that rate being well adopted in the swaps market. So liquidity has grown. We've been able to provide data on that, but at this point, we're now seeing equivalent levels of trading and liquidity in the SONIA swaps market in comparison to LIBOR swaps. And that's very important because that liquidity helps a lot of other things to happen. Futures, we've got 3 futures contracts. Liquidity is growing there, 25,000 contracts a day. And a very important part of progress has been adoption in cash markets. And this is where the FRN market has really taken things forward from considering how to do OIS to putting that in, how to use SONIA, to putting that into action. And with 25 billion worth of OIS done, and I continue to hear of new issues which are coming up, which is very good. So that essentially drying up the LIBOR need in that market and replacing it with something that works very well and is sustainable with SONIA. And then ABS is starting to pick up as well, that people thought would be very difficult, but I hear very positive things, and we've seen the first new issues and some distribution as well, which is good to date. So I think it's a question of really getting the message that it's going to happen and then seeing that put into action. And earlier this week, Tushar, chair of the RFR working group, put out a statement really encouraging lenders, borrowers, and infrastructure service providers to take advantage of this momentum and to take the next steps forward in terms of being able to build on this momentum. So this is important. And the progress in terms of adopting compounding, this is going to be the next challenge. We can talk about that later. But clearly with the FRN market, you've proved that it can work, and it works well.
Thank you, Harriet. Matt, let me come on to you and the adoption of SOFR and the progress that you've made in the US working group.
Sure. Thank you for having me. There's been a substantial amount of progress over the last year in developing alternative rates, in building liquidity in markets that are linked to alternative rates, and in developing contingencies in the case that LIBOR is discontinued. So in April of last year, the Federal Reserve Bank of New York began to produce and publish every business day the secured overnight financing rate. This is SOFR, which was the choice of the Alternative Reference Rates Committee, or the ARC, which is the public sector, private sector working group in the US. So they chose SOFR as the preferred alternative to US dollar LIBOR. SOFR is an IOSCO compliant reference rate that reflects a broad measure of borrowing overnight cash in US dollars that's collateralized by US Treasury securities. Quickly after the publication of SOFR began, SOFR derivatives markets started to develop, and today we have trading of SOFR futures and trading and clearing of SOFR swaps on multiple exchanges. Cash markets quickly followed, and since July of last year, we've had almost 100 billion of products linked to SOFR, cash products linked to SOFR, issued by market participants. Now the New York Fed is working hard on publishing an IOSCO compliant average SOFR rates, and we expect that to happen the first half of next year. And just recently, Federal Reserve Board economists produced a paper demonstrating a methodology of how forward-looking term rates could be produced given sufficient liquidity in SOFR derivatives markets. There's also been progress on the contingencies in the case that LIBOR is unusable. So the ARC, the committee, has published recommended fallback language for floating rate notes and for syndicated business loans. This fallback language can be voluntarily incorporated into new contracts that reference US dollar LIBOR to ensure that these contracts will be effective in the case that LIBOR is unavailable. So these fallback language include clearly stipulated trigger events, spread adjustments, and replacement rates. I expect very soon the ARC to publish recommended fallback language for securitizations and for bilateral business loans. And just yesterday, outside of the cash product space, ISDA released a consultation, a supplemental consultation on spread and term adjustments for fallbacks in derivative contracts that reference US dollar or Libor. And I'd encourage all of you to comment on those. So that's an example of a bunch of the progress in the US.
Thank you very much, Matt. And Cornelia, I know that you've made a lot of practical progress in converting Eonia to Esther, and I think people will be very interested to hear from you about that.
Yes, thanks, Paul. Thank you very much for having me here. So in a nutshell, the ECB will start publishing the Euro short-term rate based on statistical data on 2nd of October of this year, so covering the data of the 1st of October, because the publication will take place then the next morning. And the Euro short-term rate can then be used to replace Eonia in contracts, because Eonia is not benchmark, so compliant with the EU benchmark regulation and will not be reformed, so it will be phased out. The working group on Euro risk-free rates has also recommended that the Euro short-term rate should be the successor of Eonia. Eonia will change its methodology to become the Euro short-term rate plus a spread. So this is something that the working group has recommended, and Eonia and EMI, so the European Money Market Institute that publishes Eonia, is currently undertaking necessary steps to actually follow this recommendation. So as of October, it will no longer be panel-based, but it will be calculated based on the Euro short-term rate plus a spread. And the spread will actually be calculated by the ECB. It's a one-off spread that's based on the so far available historical average between the two rates. So all of that will be announced and made public probably at the end of this month. And EMI then also has indicated that it would discontinue publishing Eonia 2 years later, so by the end of 2021. That means that as of October, the Euro short-term rate will be there. It can be used. Eonia will also be there, but only as a tracker to Esther, and it has a life then of only 2 more years. So what is it that then the market can do to prepare for this change? I would like to stress one thing, and there's one single concrete thing that the market has to prepare for, even though Eonia will be there for 2 more years. Because Eonia will be a tracker to the Euro short-term rate, it can only be published after the Euro short-term rate. That's in the morning of the next trading day. You may all know that Eonia nowadays is published at 7 p.m. of the trading day. It will switch to next morning publication necessarily because it tracks Euro short-term rate. So that's one concrete thing that all of you and your clients will probably have to adapt to, that this calculation will only be available the next morning. Thereafter, the market has 2 years basically to transition from one rate to the other. And our working group has actually just earlier this week published a document, a so-called legal action plan that recommends how this change can be best achieved. And I think it's a very good and easily readable document that distinguishes between new contracts, old contracts, legacy contracts, Eonia contracts that mature before 2021 and after 21, and it recommends things like developing fallback language, using the Euro short-term rates plus a spread as the fallback to Eonia, and to use the short-term rate as a replacement for Eonia. So I think it's a very useful document. Then the working group will also further work on other practical issues that are related to hedging and accounting, because obviously Eonia is used also as a valuation instrument. And I would recommend you to look out for what will be coming then over the summer in forms of recommendations.
Thank you, Cornelia. Very helpful introduction. Thank you. Roman, you've made good progress in Switzerland with transition to Saron, and I wonder if you could just tell everybody about it.
Thanks, Paul. Indeed, the transition in Switzerland is well underway. Actually, our national working group has been around for 6 years now. It started out in 2013 with the replacement of the old RFR toys with Saron, and is now taking care of the Lieber transition. We are discussing all the points that have been mentioned before. A key priority at the beginning was the establishment of a derivatives market. We've been able to do that, both OIS and futures. Come back to that probably later. Liquidity is more of an issue in our case than it is in the UK or the US, given the smaller size of the market. But I think we are on track. There is one area where we had a key focus on in the last few quarters, is the question of term rate. Matt quickly touched on that topic. It's the question whether you need, in addition to, let's say, an average rate, you need a forward-looking term rate based off a fixing out of the derivatives market. Now, our national working group came to the conclusion that it's not going to be possible, or it's not likely to be feasible to have a robust derivatives-based forward-looking term rate, and recommended at the end of last year that we should base as much as we can on a compounded SARO and use a compounded SARO wherever possible. Now we might deviate a little bit from the international standard there. It's quite likely that we'll have derivatives-based forward-looking term rates in the US, UK, and the Eurozone at some point. But I think the key point to mention here is the focus on compounding, or the emphasis on compounding. That's not unique. That's something that's consistent with what's going on in the other markets as well. It's consistent with what the FSB has been recommending. The compounding approach is by far the most robust. You're not kind of putting in an additional level of uncertainty. It's by far the least volatile, because if you use a derivatives-based term fixing, there are always is an expectation component coming in. If you have an averaging, it smooths out the volatility you necessarily have in overnight rates. And I think a key component, and you guys in the room, you know that better than we do, it's definitely a huge advantage if you have on your cash products the same type of principles that you have on your derivatives products. And as we all know, the derivatives market, both in swaps and futures, in the RFR world, works on a compounding approach. So if you have as much as you can on the cash side compounded as well, means you don't have an additional unnecessary basis risk. So compounding makes a lot of sense, and we have decided, or our working group has decided, to focus on that. It is a challenge for some market participants. Right now, if you have a LIBOR-based floating rate product, you know your next payment 3 months in advance. That's not going to be the case with a product based on compounding in arrears. But there are ways to, there are compounding options that can address some of those concerns, and that's what our working group is focusing on right now. We have an outreach. We had an outreach with infrastructure providers that stuff can be implemented in the most important systems out there. So we think that will be a feasible solution in Switzerland. So all in all, transition is on track, but still a long way to go.
Thank you, Roman, and I think that brings us on naturally to the challenges that we all face ahead and the market faces. There are many of them: term rates, fallbacks, there are also regulatory issues, accounting issues, tax issues. What I'm going to ask each of the authorities is, what are the key ones, and how far have we got in each case so far? Harriet.
So I'm going to echo this point about use of the overnight rate in a compounded form in cash markets. So I think that's a key challenge ahead, taking what's obviously workable in the FRN market and testing it and seeing how far that can be used so that we get all the synergies and benefits from that. And one of the other challenges is to think about having good levels of adoption of these alternative rates. And some of that may include term rates, but particularly on the overnight rate, to prepare for the day when an IBOR, and particularly our focus from the FCA is on LIBOR, is either just not suitable because the liquidity there is not good for trading or transacting, or indeed a trigger event has occurred and you can't use it. So not to wait to test things, to use things, to rely on liquidity on the last day. Get in there now, find a way to meet customer needs with these alternative rates, test them, build them, use them in good time, before 2022. So that's one key challenge. I think we can rely on the private sector to come up with competitive product offerings, and the work that the UK RFR working group has done, and I know, Paul, you really were part of the genesis of that work on conventions, the paper that was published several months ago, set out information so that other markets and participants consider what conventions will work. So that will help new product development and for liquidity to coalesce around the right conventions. I think there are further challenges with regard to consistency, and this crosses over to the conventions. Certainly we hear from market participants, and I very conscious of the desire for there to be high standardization so that liquidity can build, so that things can go well. So there is a large interest in consistency. That is also that there be consistency across markets so that things can work well, because rarely does one large financial institution rely on one currency or one product. Often things are combined. So that consistency is important. And then there are operational issues, and I know that for the FRN market, those operational issues were handled pretty well. I think there's still some infrastructure work going on. But for other markets, there will be distinct operational challenges, infrastructure changes or adaptations that will be needed. And that needs to happen in fairly short order. And then you referred to the regulatory, accounting and tax. Perhaps you'll talk about that a bit later, but that would be another challenge. So I've got 4, which is adoption and consistency, operational issues, and those combined regulatory, accounting and tax issues.
Thank you, Harriet. That's very helpful. Matt, in the US, you have challenges as well, and I think it would be very helpful for people to hear a little bit about them and how you're going about tackling them.
Sure, yeah. Some of them are very similar to the ones that Harriet mentioned, and we do coordinate amongst each other on a global basis that we can talk about in a little while. But specifically to the challenges that we're facing in the U.S. So the most imperative challenge is to just stop using LIBOR. Market participants should stop entering into new agreements that reference LIBOR and should start using SOFR in U.S. dollar transactions. Systemic risk is growing with each new contract that's written on LIBOR, and systemic risk would be reduced if those contracts are instead entered to in SOFR. If you must write contracts in US dollar LIBOR, we urge you to incorporate robust fallback language that contemplates a cessation of LIBOR. As I mentioned earlier, the ARC, the US Public-Private Sector National Working Group, has published recommended fallback language. This is for voluntary use, but safe fallback language is really a necessity if you're going to continue to write new contracts with LIBOR. Another option is to close out existing positions that have reference to LIBOR, and then establish new positions with SOFR. Another challenge, similar to what Harriet mentioned, deals with systems and technology. To address this, the ARC is in the process of establishing a working group, an operations and infrastructure working group. This work is going to get kicked off next month with a vendor workshop where working group participants will have the opportunity to interact with key vendors of software and technology that are really important to operationalizing the transition to SOFR. Another challenge that hasn't been addressed until this year relates to consumer products. So most of the ARC's work for the last year or so has been on institutional products. Consumer products also have exposure to LIBOR and have particular sensitivities related to consumer issues. So the ARC has formed a consumer loans working group to ensure a fair and transparent transition for consumers. And this work will be carried out by lenders, by investors, by servicers, and importantly by consumer advocacy groups. Another challenge is to ensure the transition doesn't get tripped up by tax and regulatory and accounting issues. The ARC has working groups on regulatory issues, a separate working group on tax and accounting issues, and the purpose of these working groups is to surface, identify, and try and address potential obstacles that can impede the transition to SOFR. So some recent examples of output of these groups are just this week, the regulatory letter that the ARC published, that the ARC wrote to global authorities requesting some relief from derivative transaction, from margin for derivative transactions that reference alternative rates. So these are examples of some of the challenges and how we're trying to address some of them.
That's very helpful, Matt. Thank you. And some key messages, I think, there for market firms in the room. Cornelia, challenges that you see in the euro area and how you're delivering them.
Yes, I must say many of the challenges that Harriet and Matt have mentioned would also apply to the euro area on transition issues, tax accounting issues. I mean, now they apply for us for the Ionia transition, but they're equally important. But one other challenge I would like to mention is communication and outreach, because, for instance, the end of Ionia is something that everybody in this room may be aware of, or most big financial market players in the euro area will be aware of, but not everybody is, but many more people are affected of this. So it's a challenge, I find, to reach out to everyone. And I think here also the banking sector, has a very big role to play, because you will have to reach out to your clients to make sure that they understand what is happening, because we have no really good means to do that. And also on the topic of communication, just to stress, Euribor is not Lieber. Yeah, no authority has announced a fixed end date for Euribor, so we operate under the assumption that we will have Euribor for a longer time. And in fact, Euribor is currently being reformed to make it compliant with the benchmark regulation. Was until very recently still purely quotes-based, and it's moving towards a hybrid methodology whereby transactions will be used as much as possible. And this process is taking place right now, and the regulatory authority will have then to confirm it. So currently we are in this phase of phasing in a better version for Euribor. Now the working group is now intensifying its work on looking at fallbacks for Euribor, which is very important. And there we have now the debate between forward-looking, which type of forward-looking or backward-looking rates, much like already Roman and Harriet have indicated. And it's a very challenging task, because one has to weigh what would be the best solution going forward for different asset classes. We have to take into account the very supporting work done by ISDA on fallbacks for the derivatives world. And then finally, we look at what is being done on the international arena, because we obviously learn from what is being done in the other groups, and we exchange also the different arguments, which may have a different weight in different countries, but still we consider all of this, because obviously it will ease the transition if all go in a little bit in a similar way. So let me stop here. There are many other challenges.
Thank you, Cornelia. And I think there are important messages there also for market firms in the room. This is not just preparation for you, it's for you to talk to your clients, and law firms in the room. This is also a question for you to talk to your clients. Roman, from a Swiss point of view, if you look ahead, what are the remaining challenges as you see them?
It's a true privilege speaking last, because most of the points have already been mentioned before. So there are only two points I would like to mention in addition. Matt touched on the consumer product sector and the need to kind of educate the broad public and not just the institutional investor space. That's a key challenge for us as well. In Switzerland, Lieber mortgages are quite a popular instrument, similar to some part of the Eurozone. And it's a different story if you have to kind of educate the general public about such a very technical topic. And that's what you're trying to do. You can do that through the press, through industry groups, but in the end, it will have to be the banks talking to their customers and explaining why the change is necessary, inevitable, and how the new world is going to work. And I think the second part, where we have probably a bit of a Swiss-specific challenge, Harriet mentioned in her opening remarks the tremendous progress they made in terms of getting liquidity into SONIA-based derivatives markets. I'd love to be able to say that as well about the Swiss case, but unfortunately I would be lying. We have established SARON-based derivatives products, but liquidity is still very thin. And I think that's probably more difficult in a smaller market to get liquidity into, from, let's say, the LIBOR-based market to the RFR-based market. And what we think we need adoption on the cash side, especially on the mortgage side, on the loan side, in order to create a hedging demand in derivatives. And we need to make some progress on that front.
Thank you very much, Roman. And I think that brings us on to the question of how we are going to deliver the transition to risk-free rates. And I think there are two aspects to that. There is what the authorities are doing and what the authorities think the market needs to do. And on what the authorities are doing, I think we have at least two different issues here. One is the coordination internationally between the authorities, but there's also the question of supervision, that supervisors are making sure that supervised entities, including many in this room, are preparing properly. And Harriet, I wonder if you could start on this and explain in particular how the Financial Stability Board Official Sector Steering Group works to coordinate internationally and take it from there.
Yeah, so looking at how we coordinate, well, of course we have opportunities in many different forums to speak to each other, as well as simply being able to pick up the phone or convene a call on an important issue. But very helpfully, the Financial Stability Board did provide a remit for the Official Sector Steering Group on interest rate reform to pick up this issue and focus us on working together to address this as regulators and as central banks. So we have regular meetings, and I hope that, Matt, you might speak about the meeting just last month that was in the in New York. But being able to discuss and identify key areas where authorities can either simply inform, put a light on, and I'll give an example where last July we put out a statement when a number of different things which are interrelated to transition were occurring. We put out a statement about overnight rates and term rates, and to give the market a view of what the world will look like in the future across our international markets. That was where we were able to do something that was in the public domain. Another key area where we have focused our resource through the OSSG is in asking ISDA 2 years ago to pick up the challenge of robust fallbacks for derivatives, and they've done a very good job. They've consulted on a set of rates, including sterling and Swiss. As Matt mentioned, they've now started a new consultation. I think yesterday it was released for the dollar LIBOR, also for CDOR, HIBOR, and for the dollar component of SOR. And they have a second consultation which has kicked off yesterday on pre-cessation triggers, so that the synchronization of movement off of these rates in a bad situation where really there is an unrepresentative rate and an official notice has been made about that move must happen, can be synchronized across different markets, not just for one currency but for another. And so this is very important that the market engages in that. But these are two examples where the OSSG have put things into the public domain, worked with the private sector, particularly with ISDA in this instance, on preparedness for transition.
Thank you, Harriet. And I would just like to thank ISDA for being with us today, and indeed many other trade associations around the world. Thank you. Matt, perhaps you'd like to pick up from a SOFA point of view some of the points that Harriet has introduced.
Yeah. Well, I mean, they're not really SOFR specific, and that's kind of the point that we're looking across currency jurisdictions, and just to demonstrate the seriousness that our two institutions take, the FSB's official sector steering group is the leadership. So this group is co-chaired by Andrew Bailey, and previously by Jay Powell, and more recently John Williams, the president of the Federal Reserve Bank of New York. So now Andrew and John are co-chairing the OSSG, which just shows the gravity that we take these issues. So last month, the FSB held a roundtable in Washington, D.C. With the public sector representatives as well as private sector representatives, and media was present for this. The public sector urged kind of a strong sense of urgency to the private sector, the importance of this transition, and the private sector came back to the public sector requesting clarity on regulatory, tax, and accounting issues, which importantly is being taken up by the OSSG in working groups at the international level. So we have representatives from public sector and from private sector across jurisdictions thinking about harmonization where possible on some of these transition issues. So one specific market that kind of was picked up in some of the working groups that the ARC had established that required international coordination was the cross-currency basis market. And so kind of a subgroup formed from this working group where we had official sector, we had private sector, we had US, we had lots of other jurisdictions present, and work continues on finding some solutions to how cross-currency basis swaps will be impacted and how the transition will affect those markets, and trying to find some technical solutions to some of those that are being put forward by the private sector. So that's a real practical example of how maybe some of your businesses could be impacted, and that the role that some of your colleagues have played in helping move that work forward.
Thank you, Matt. Cornelia, you're involved in all these global groups as well, but in addition to that, you coordinate between the ECB, ESMA, the European Commission, the FSMA in Belgium, and so on. And I think it would be helpful if you could just say a word about how you coordinate.
Yeah, indeed. So the ECB is providing the secretariat to the working group on risk-free rate, but we have also several subgroups, and actually one of them is chaired by ESMA. And we coordinate everything with the Commission, with Sean Berrigan's team, and ESMA, and also the FSMA, who's the supervisor of EMI, so that we have very close interactions. But also on the working group level, I believe that the chairs of the different working groups in the various regions of the world, they are also in close contact. So I know they have teleconferences and bilateral calls, and I think it's safe to say that also the private sector, I mean, we have cross-membership in some of the groups, and they learn a lot from each other. For instance, what types of institutions even to engage in the working groups should be taken on board, except for maybe the core banks, who at least in our case were the founding members in a sense, but we get more and more people on board, and we follow there also what's being done in other areas.
Good, thank you. And we had Verena Ross of ESMA with us here yesterday, as you know. Roman, the direction of travel globally is the same among all the authorities, but it's not a one-size-fits-all approach. I wonder if you could say a word about that from a global perspective.
Absolutely. I think coordination, as you've just heard, it happens both on the public sector side as well as on the private sector side. But coordination doesn't mean that we will end up with a uniform solution across the globe. We're not looking, as you mentioned, we're not shooting for a one-size-fits-all solution. Lieber had that to some degree. He had the same type of principles in all the jurisdictions. It was easy to handle that. It's going to be a bit more complex in the new world going forward. But I think it makes perfect sense. And again, you know that better than we do. Each market has its unique features, its unique set of circumstances. And it makes sense to tailor the solution those circumstances. And one of the examples, the easiest one, just look at the RFRs that have been chosen. Obviously, the UK and the Eurozone decided to go for an unsecured rate. The Federal Reserve and we decide, or the US and we decided to go into the direction of a secured funding rate. But each of those choices make perfect sense if you look at each of those cases. And just because we ended up with slightly different types of rates doesn't mean it's not going to work. And it doesn't mean there is no international coordination going on. So it is a more tailored approach, but there is, it has to be coordinated on the global level, and it is.
Thank you very much, Roman. That's an important point. And now I want to come on to the question of what the market should be doing. And I'm going to ask each of the panelists in turn, starting with Roman, what are the messages that you want to put across to the market about what the market needs to do and when it needs to do it? Roman.
I think first of all, and Matt made that point very well, it is a joint effort by the private sector and the public sector. We try to facilitate the process, to support the transition, but we can't stress that enough. A lot of the heavy lifting is done by the private sector, and the support we get in these working groups by individuals and institutions is tremendous, and is paramount importance, and that has to be the way to move forward on this. So, but I think more also a lot of you are probably not dealing with that on a day-to-day basis, so you might more indirectly be affected. I think the important point is stay informed, stay in the loop, try to adopt the new RFRs as quickly as possible and as broadly as possible. And I think for me personally, the point we have to make, it's a high degree of urgency. We're talking about the end of 2021 for the FCA support for Lieber kind of falling away. That's less than 3 years that's 2.5 years to go. Given the complexity of the transition, that's not a long time. So we have to treat that issue, that transition, with a high degree of urgency. Thank
you. Cornelia, the messages you want to get across to the market.
I can echo everything that you have just said. I mean, the public-private sector partnership on this, I mean, we're all striving to find the best solution going forward. That's very powerful, but it's only the start. So in the end, the real work then has to be done in each institution. So as regards the Euro area, I would recommend all institutions to do stock taking first to understand where you use EONIA in your contracts, in your valuations, and be very specific here, have a very good list, and then think of what the steps that need to be taken, and then you can use the legal action plan that we have put on that the working group has put on the website, and further documents that will then follow likely in July on the accounting issues. So I think that will be the best guide that you can get. There will be no general help really then coming from some public authorities, in the sense that there will be a law that changes from one type of contract to the other. So that will not come. It has to be you who has to do all the practical nitty-gritty, unfortunately, work. And in the case of EONIA and many of the other products, actually the end of 2021 is really when you will have to have finalized the transition. But of course, some elements should take place earlier on.
Thank you, Cornelia. Matt, from the perspective of the US authorities, what are the messages you'd like to get across to the market?
Similarly, don't wait until the end of 2021. By my count, that's 959 days. Each one of us should be doing something each day to minimize the disruption for when that day occurs. It will be much smoother if transition is made over the course of this period, as opposed to a big bang at that date. So stop writing contracts that reference Lieber, start using SOFR and other alternative rates, use fallback language that is robust, that contemplates a cessation of Lieber if you do write Lieber contracts. Outreach and education. So this group here today, we are essentially the core of the financial system, and similar to what Cornelia mentioned in her previous intervention, engagement from outside of this core, awareness and engagement is limited, and in some cases close to nil. So it's upon us to educate colleagues and customers and clients and vendors and beyond. And lastly, I'd say this is the joint effort between public and private and across jurisdictions. Surface issues, if there are, maybe there are issues that haven't come to the fore yet. The public sector is very welcoming of identification of issues, of possible solutions, and working together. So as Cornelia said, this isn't something that's going to be mandated from the public sector. And so we work together. You on the ground tell us what's working, what's not working, what the challenges are, and then we work together to find solutions.
Thank you, Matt. Harriet, from the perspective of the UK authorities, the messages for the market.
Well, I think we've moved away from that debate, is it going to happen, to what do we do? And that's very important. So surfacing up the issues, finding solutions, where there's a third party or a markets issue, dealing with that. A lot of that is very granular, but there are bigger issues that can be surfaced, and where, as authorities, we do want to hear from ICMA, from AFME, from other trade associations, from individual firms about what's a problem. You know, whether it's an accounting issue where, given that we want to see transition occur, can the other things like the IASB guidance on looking through changes or margin adjustments which have happened through the statement from the BCBS, IOSCO, and how that can be mirrored in the US. These are all important areas where we can do something as authorities to help. But the key thing is to take on that this will happen and to be prepared and to be into implementation mode by the end of this period. So you know, it's very good to come here, and you know, I know from meeting people that the debate has moved on from surely this isn't going to happen to clearly this is, but to the actual work that needs to occur so that things can be addressed and this transition can be a very smooth transition by the end of it, and where fallbacks are useful, but they're not a major construct in how the transition may occur.
Thank you, Harriet. So you've heard from the four authorities about the main messages. There is a lot of relevant information on the risk-free rate working group websites for the different countries, currencies. There is a special web page on the ICMA website which sources in and links into the work of the authorities and the market, including ICMA and other trade associations likewise. So please make use of that information. The message is with you to take away today of the need to prepare for the transition to risk-free rates in yourselves, both as market firms and law firms, but also crucially to talk to your clients about this and to make sure that they understand what the transition involves, and so that everybody is properly prepared for something, as Harriet said, that will happen, and that you will affect all of us and that you all need to be prepared for. The panel is going to stay behind to talk to you during the coffee break in a moment, but I would like you to thank the authorities for coming over today to talk to us all. Thank you.